Welcome back, my awesome people. In today's episode, I will be briefly highlighting one dividend stock that I have been investing over time and feel like it has not been getting the spotlight that it truly deserves. This stock is a Canadian high dividend paying ETF. Now, for those who are not familiar with ETFs, it is simply a stock that holds other stocks, sort of like a basket. For more details and a deeper look into ETFs, check out my video. This one explains the basics of ETF stock. So without further ado, the stock that I will forever be buying and wanted to put a spotlight on is the BMO Canadian High Dividend Covered Call ETF. Ticker symbol ZWC, a 7.2% dividend yielding ETF of wonderful, amazing, high yield Canadian companies held for the quality and long-term growth potential of their dividends and distributions. These include Canadian National Railway, CIBC, RBC, Manulife, Enbridge, and other high-profile Canadian staples. Now, ZWC is pretty much a one-stop shop for those seeking passive monthly dividend income. ZWC is just like any other dividend-focused ETF, but with one major difference. This ETF leverages the covered call strategy, which incorporates the writing of covered call options. Such options limit capital appreciation for some extra premium income upfront. In flat or down markets, ZWC comes out on top. In a soaring market, not only would ZWC miss out on capital gains in exchange for the certainty of premium income right off the bat, but investors would also have to pay the fund managers a 0.72% MER, or management expense ratio. And when compared to mutual funds, a 0.72% MER is pretty low. But as far as ETFs are concerned, a 0.72% MER is kind of on the rich side. But if you factor in the MER, the dividend yield is still a healthy 6.48%. So, in short, ZWC's juicy dividend yield is no trap. In fact, the distribution is well supported by the dividends of some pretty wonderful businesses like Canadian banks and utilities, and of course, the covered call options writing strategy. And for more strategies and tips on money, investing, and creating financial independence, follow me on my Twitter at Jacob Rant and get bullish on that subscribe button for the YouTube algorithm and smash all the likes, bells, and whistles to get all the updates on my many fantastic investments. And comment below with what ETFs are in your portfolio, because I do reply to every comment. And if you are watching this video and do not have a Wealthsimple trade account and you want free money to trade with $0 commission fees that won't eat into your profits, especially if you're buying penny stocks, sign out with my Wealthsimple link down in the description box below for $25 of free real money. Link is below. Now, with ZWC, you're getting premium income from the writing of covered calls that goes on top of the income you'll get from dividends. That's like a double dose of income in exchange for upside potential. Sure, you'll still face substantial downside, which I will get into later in the video, but at least you're getting paid a fat check while you ride this uncertain roller coaster ride of a market. So, what's under the hood? What does ZWC own? Well, for the most part, high quality companies. The brilliant managers at Bank of Montreal, or BMO, have handpicked companies that are less likely to crumble, even during crises like the one we find ourselves in now. A majority of the companies in ZWC are well capitalized and have what it takes to weather the current storm we are in and any other future storms. ZWC owns plenty of Dividend Aristocrats, including the Canadian banks, which, while stressed, are unlikely to slash their dividends. It also owns several REITs, utility, and telecom companies that are well positioned and committed to continue paying outsized dividends. In a time where high dividend yields are being cut, being removed, and in some cases very rarely being increased, it is still not easy to find high-paying dividend companies. But ZWC is a must-buy if you're no stranger to volatility. Never panic with ZWC. Buy the dip and you'll probably be pleased with your results in a few years from now, when the idea of a safe 7% yield will be unheard of. Now, the downside. The dividend yield on covered call ETFs look very tempting, and there is a catch for why it is. Typically, the dividend yield on covered call ETFs is anywhere between 4 to 7%, which is substantially higher than the S&P and TSX's current yield of about 2.7%. The high dividend yields have made these kind of ETFs popular with income-seeking investors like myself. But if more people understood how covered call ETFs generate that extra yield, they might not be so keen on them. The truth is that investors are sacrificing potential gains and often paying higher fees in exchange for putting more income in their pockets. So, a covered call ETF sells call options on their holdings. They're known as covered calls because the ETF owns the stocks on which the contracts are written. A call option gives the buyer the right to purchase the shares at a specified price before a specified date. When an ETF sells a call option, it collects a premium dollar amount from the option buyer, and it's these premiums that allow the ETF to pay out additional income. So if it were that easy to make money, we would all quit our jobs and write call options. But there are risks with this strategy. For example, say you buy a share of company ABC for $50. You want to collect some extra income, so you write a covered call option on your share for $3. Let's assume the option gives the buyer the right to purchase your ABC share before a specific date for $52. You're happy because you got to pocket the $3 premium and you still own the shares. As long as the price of ABC doesn't rise above the $52 strike price, the option buyer won't call away your share because they can buy it on the open market at a lower price. So far, this looks like easy money. But what about if ABC rises to say $58? Now, the option holder would then exercise their right to buy the share from you for $52 because now they're getting a good deal. In this case, your total profit would be $5. $3 from the premium that you received and $2 in capital gains for a return of 10%. Now, that seems pretty good. The average is about 10% of a good return. And it is until you compare it with the return that you would have made if you hadn't written the option. In that case, the $8 capital gain would have been all yours. And that is a 16% return. Now, this is a very simplified example, but it shows one of the main drawbacks of covered calls. They limit the ETF's gains in a rising market. In exchange for receiving cash now, you give up potential upside later. Since the stock market generally rises over time, this can be a lousy trade-off. This just means that the covered call ETF option strategy is likely the most effective when the underlying stocks of the ETF are not volatile. So what are you doing with this stock, Jacob Rant? Well, I have not been positioned in this ETF for too long, but I already do have a good foundation that I will continuously be adding to. The current price of about $18 a share with a 7+% dividend yield that pays monthly, and the fact that the Canadian economy is not back to pre-COVID levels, and the fact that some of the holdings in ZWC are crown corporations and Canadian staples shows that for now, unless something crazy happens like an alien invasion, these companies will be bailed out by the Canadian government if they were to fail. For those unfamiliar with the Canadian economy and infrastructure, Canadian banks are the most reliable and foundational to Canadian living and society. And the fact that ZWC is a Canadian bank-heavy ETF gives me a better safety net when compared to other industries in Canada. Also, my intention with ZWC is not chasing its potential growth, but instead the reliable dividend income. So all in all, I will be forever buying this stock, but make sure you do your own due diligence. And again, if you are watching this video and do not have a Wealthsimple trade account and you want free money with $0 commission fees that won't eat into your profits, especially if you're buying penny stocks, sign up with my Wealthsimple link down in the description box below for $25 of free real money. Link is below. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth out there for all of us to get a piece of. So by allowing our hard-earned money make us more money is the key to financial wealth and the key to financial success. Subscribe, like, and share to help out the channel, and so you will get notified of when I post my penny stocks, REITs, dividend, and speculative stocks from my portfolio and other investments I am currently buying and selling. I want everyone to have the opportunity to get out of this work-life trap by buying back their freedom through investing. So let's all ride 2021 together on a journey of health, love, success. So until the next video, stay ranting.